Today I'm sharing an important update on Deepak Builders, a stock we had tracked earlier, booked profits around 175, and then saw a sharp correction over the past few weeks. The stock is now trading below 140, and many viewers have asked whether this is again a buy opportunity or if the weakness is still continuing. So let's break this down clearly based on the latest numbers and the current market structure. First, the company has released its Q2 FY26 results, and the quarter was definitely weak. Revenue came in around 45 crores, profit dropped to roughly 5 crores, and EPS has diluted to a little above 1 rupee. These numbers are significantly lower than the Q1 performance, and that's exactly why the stock corrected sharply from higher levels. Now, does a weak quarter automatically make a stock a bad investment? Not always. What matters is whether the correction has now created a high-risk, high-reward opportunity for aggressive traders. And in this case, the answer is yes, but with strict rules. This is not a normal safe entry. This is an aggressive value play setup. So if you are a conservative investor, it's better to wait for stability. But if you're someone who understands risk management, position sizing, and stop-loss discipline, then this setup can work as a tactical opportunity. Here's how we approach it. We don't buy full quantity at one level. Instead, we use staggered buying with strict limits. The first tranche is small, around 30% of your planned amount, and you take that near current market levels below 140. This gives you initial exposure without overcommitting. The second tranche, around 20%, should only be added if the price dips into the 120 to 130 range, or if the company puts out some positive update, like an order win, execution restart, or improvement in project flow. This keeps your average price safe and prevents you from catching a falling knife. The final and largest tranche, about 50%, must be added only after you see actual confirmation. And what do I mean by confirmation? It means revenue improvement in Q3 or Q4, profits picking up again, better order visibility, lower receivables, or at least management commentary that clearly shows execution recovery. Without this, you should not scale up your allocation. Now, let's talk about stop loss and risk. This is the most critical part. For this particular trade, the hard stop loss is fixed at 115. If the stock closes below 115, you must exit fully, without trying to average further. A stock can always bounce back later, but your capital must be protected first. The overall exposure to this stock should also be limited. Since this is a high-risk trade, your total position size should not exceed 5 to 10% of your entire portfolio. This way, even if something goes wrong, the damage is controlled. On the upside, the targets are defined at multiple stages. The first short-term target is around 150, where you can book about 1/3 of your holdings. The second target is around 165, where you book another big portion. If the company shows improvement in Q3 or Q4, then the stock has the potential to recover toward 180 to 200 on the positional side. That's where you book the final part of the trade. At the same time, if the stock crosses 155, you should move your stop loss to around 138 to 140 so that you protect your capital and lock your profits. And after that, you can trail the stop at around 8 to 10% below each new high. So overall, this is not a blind buy. It's a structured, staged, risk-managed trade that only works if you stick to the rules. To summarize in simple words, weak Q2 results triggered a big correction. This correction has now created a value zone, but only for aggressive traders who follow strict stops and position sizing. You enter small at current levels, add only if it dips or if the company gives a positive update, and add big only after recovery signs show up in the upcoming quarters. Targets are 150, 165, and maybe 180 to 200 if the recovery is strong. And the stop loss is fixed at 115. As always, this is an educational view, not financial advice. Make sure you evaluate your own risk profile before entering such a setup. If you found this breakdown useful, hit the like button. Subscribe and stay tuned for more structured analysis and updates. Thanks for watching. I'll see you in the next video.